my name is Ewan and I'm with Clark, and today we are going to be showing our clients what we think are different types of good investments. By the end of this we will show you what we think are the best investments to make, and by the end of it we'll also show our client what we think is the best way to invest 100k. The first type of investment you can make is the S&P 500. The S&P 500 is Standard & Poor's 500 and is a stock market index that tracks 500 publicly traded domestic companies. Many investors see it as the best overall measurement of the American stock market performance, as it is a top 500 American company, so it is a very stable market, and it averages an 11.82% return since 1983. The S&P 500 is currently valued at £4,066, which is an increase in 1,440 over the past 5 years. It also has a most recent day range of the lowest £3,999 with the highest £4,017. It also has a year range from last year of £3,491.58 and the highest £4,634.30. The expected returns over the next 10 years with the S&P is expected to be minus 11.53% in year 1, by year 3 18.45%, year 5 10.75%, and by year 10 it's expected to be 12.2%. A type of S&P 500 you can invest in is the Vanguard 500. The Vanguard is currently valued at $366.34 with a 133 increase, which is 55.3% over the past 5 years. Vanguard is well diverse with tech and healthcare, which is good as those are two very good sectors, with tech being an up-and-coming and very important sector right now, and healthcare being a very vital sector for everyone. It also has had the returns over the past 10 years of 8.26% in the first year, 9.84% in the third year, 9.5% in year 5, and by year 10 it had 17.64%, which is 10.35 after tax, which is what you would expect if you were to invest in it after 10 years. It's also seen as a good investment for beginners, as it is a fairly solid one in the S&P 500, with it having good returns and also being well diverse in tech and healthcare. Another one is the Fidelity 500 index. This index is valued at $140 with an increase of $49, which is 54.12% over the past 5 years. It has grown massively since it started in 2011 and has a 5-year annualised return of 9.41% after tax. It's seen as a good sector with good potential, and if you were to invest in it, then the money you would be expected to get back from it is very similar to S&P 500 over the next 10 years, with 11.32% in the first year, 17.84% in the third, 10.72% in the 5 years, and by 10 years it is 11.86% respected. It also has dividend payments over the past 3 years of 1.29%.
Hi, my name is Clark and I'll be running you through the real estate part of this portfolio. So for the real estate, we decided to research into the 3 largest local cities for student population, these being Manchester, Liverpool and Leeds. However, once we looked into Leeds, we realised that Manchester wasn't a great fit for investment. There wasn't much profit to be made, especially in comparison to Liverpool and Leeds, which the potential for growth investment is high in both of them. To start with, I'm going to look at the averages for Liverpool and what you can expect. So your average flat price is looking at £163,158, which means that you're looking at a down payment of £16,315.80, which when calculated as a 30-year mortgage with a fixed rate of 5.5%, which is the national average as of right now, you're looking at a monthly repayment of £833.75. Right now, the average monthly rent in Liverpool is £940.33 in the city centre, which means that you're looking at an average of profit per month of £106.58. Once we start to look at an example of a flat in Liverpool, on the 15th of July 2021, there was a 2-bed, 2-bathroom property that sold in Liverpool city centre for £170,000, meaning you have a down payment of £17,000. Due to this property being a 2-bed with ensuite, we believe that if you lowered the rent to £550 per person as opposed to the £940 average, you're looking at £1,100 overall as a property per month. Once calculated against the mortgage repayments you'd have to pay a month, you're looking at a monthly repayment of £868.72, leaving you a profit of £231.28 per month, with the £1,100 per month rent coming in. Put inside £5,000 of your initial investment to an extra £5,000 for expenditures and fix-ups and everything like that. You're looking at £22,000 investment, which with this profit of £231.28 a month, it will take you 8 years to repay that initial investment. Again, looking at Leeds as an average, you're looking at an average flat price of £179,693, with a standard 10% down payment of £17,969.30. Calculated again with a 30-year mortgage at 5.5% interest, you're looking at a monthly repayment of £918.25. However, Leeds operates with a higher average monthly rent of £1,072, meaning that you're looking at an average profit of £153.75. Looking at another example, this time for Leeds, a more recent property that was sold in November 2022. It was another 2-bed, 2-bathroom flat, which was in Leeds city centre, that sold for £188,000. Again, with a standard 10% down payment, this initial cost will be £18,800. With an extra £5,000 put aside, it will take you to £23,800 as your initial investment. With this flat also being a 2-bed with ensuite bathrooms, alongside these having a higher average rent, we believe that £600 per room is an adequate basis to start your rent at. This will bring £1,200 in a month in rent, which means that you're looking at an average repayment for this property of £960.70, leaving you with a profit of £239.50 per month, which to repay this £23,800, it will take you 8 years and 4 months to repay, which means that the property then becomes an asset.
Bonds are another type of investment that we would recommend, and a bond is a fixed income instrument that is a loan made by an investor to a borrower that is either corporate or government and is paid back over a period of time with interest till either the bond is sold on the stock market or reaches maturity. Government bonds are good for stable domestic or international investment, whereas corporate bonds are risky as a company is more likely to go bust but have a higher growth potential, and companies can also default on your stocks, which make it a risk. The bonds can either be kept on maturity date or sold on the stock market. If they are kept on maturity date, then the money that you have invested into it, let's say that was £1,000, you receive interest on it up until the maturity date, and when it reaches the maturity date, if you still have that investment, then you get that 1k back plus the money you've made from the interest rates. If you sell it on the stock market, then you could make a profit or loss, as the stock could be different price compared to where you first bought it. An example of a government bond I recommend investing in is the Linux Core UK Government Inflation Linked Bond. This bond invests in UK government securities, which is good as the UK government is unlikely to default on its debts. It's also inflation linked, which is also good, as most bonds don't have any protection against inflation, which is important because the money you get back from the investment is based on interest rates. So if inflation goes up, then the interest rates go down, meaning that you make less money over time from your investment. It also has good dividend payments, as it pays twice yearly dividends, an average 12-month yield of 0.45%, and as of January 23, the fund size is £71.3 million. Another good investment is Vanguard Total Bond Market ETF. This is investment grade bonds, government bonds, so they are above the investment grade, which is good, as if it's above then it is seen as a very good bond. Is made up of 17,000 bonds equating to 86.5 billion as of the 22nd of Feb 2023, which is good, as having a range of different bonds invested in means it is good income for diversity compared to equity, as you have a better range of stuff. And despite its low risk, the fund returns are surprisingly positive after 13.11% returns in 2022, and as of February 2023 so far, returns are now 0.56%. A third bond you can invest in, which is a more riskier one, so you could get a better return from it, is the SPDR Bloomberg High Yield Bond ETF. The bond fund is comprised of junk, which has been given low credit ratings by the rating agencies below investment grade, meaning that it isn't seen as that good of an investment by them, but because it has a large net asset of $9.71 billion, it means that it also has very good potential within lots of assets that it has. The lower rating is, so with the lower rating of the money, it could be seen as a better investment compared to the other bonds, which are government bonds, so they are more likely to be solid and not go down compared to where this one could, but this one could increase more. Overall with bonds, if you hold the bond to maturity, you get the money back, and it could be sold for more or less if you don't. We'd recommend holding a bond for about 3 years, so if you try and get one for the maturity for 3 years, that's what we recommend, as the more time you hold the bond, the more risky it gets with the prices that could be changing if you want to sell it. And one thing with bonds is they are less volatile than stocks or other equity investments.
And finally, I'm going to speak about investing into companies and into stocks. See, no stock can be considered as safe. However, there are more stocks that can be considered as safe, stronger and more reliable than others. Within this portfolio, I'm hoping to show you a wide range of stocks and bonds that can be invested into to create a range of risk and return over a short and long-term period. To start, we're going to start with the least risky investment you can make here, which is the S&P 500. I'm not going to go too much into this as it was spoke about earlier. However, we want to bring it back up again just so we believe that it's worthy of it. After researching into many different large companies, we decided that the Walt Disney Company is the company that we would recommend you putting your money into. The reason for this is just because of the wide range and the wide portfolio that this company has. Disney brings in money through their merch, through their parks, through their cruises. You've got Disney Plus, they own Marvel, ESPN, and many others. It just means that with a portfolio like this, they're less likely for everything to crash and then you to lose your money. Moving on, with a slightly riskier stock to go into, we would recommend investing into new technology. Right now, that being electrical motors. We would recommend investments into electrical car companies such as Tesla or Polestar, which have seen a huge success in recent years with the growing popularity and success of eco-friendly vehicles. This alongside Tesla seeing an 80.9% increase in their stock prices since January 1st, 2023. Finally, we're going to talk briefly about cryptocurrency, which is the riskiest of the stocks that you can go into. This is because they're very volatile and unpredictable. However, the opportunity for large amounts of growth in the future is hard to pass up on. We would recommend only investing into this what you may be willing to lose, maybe 1 to 2% of your portfolio. This is just because it could easily skyrocket, so even a small investment like this will see a high return, but on the other side it could go down as we've seen in the past. A list of the best cryptocurrencies has been linked in the notes below. These include Bitcoin, Ethereum, XRP for an example. This is because they have a high market cap, which means that they are seen as being stronger and more capable within the market. For example, Bitcoin has a market cap of 350 billion, which means that the opportunity for growth is much higher. Finally, this is the percentages of where we would recommend that you invest your money. So we would say 30% into the S&P 500. This is £30,000. It's because £30,000 put into the S&P 500 with an average return of 11.82%. As that compounds over time, you're seeing a high return from all of this. 25% into real estate is £25,000. This is enough to put a down payment on, cover expenditures and anything else that you may need, especially in Liverpool and Leeds, as shown by the examples. We've gone for 20% both in stocks and bonds, as you want around a 50-50 split of equity and bonds in your portfolio. But we would also recommend keeping 5% to £5,000 as savings or cash, just in case a rainy day happens where your car may break down, something like that, just because this is the most liquid your money can be. And finally, thank you for listening, and we hope that you take our recommendations on board.